Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. I think it's fair to say that this commodity has been frustrating me a little in recent times. It's only when I looked at my longer term monthly charts that I was able to decipher a little of what had been going on and to give credit and warnings where they were due. So if we look at my longer term monthly chart, we can see that the action since as far back as the low seen in August last year till today has been a sideways action. I noted this 24 weeks ago and I will expand on that shortly, but I just wished you to see that this sideways action is not done yet as to whether it is a halfway hesitation lower or a basing action that's going to move higher. Back to my daily charts, and 24 weeks ago I highlighted a bright pink July 24 to date rectangle pattern, currently 959.5 to 1100 and 3/4. This pattern is still operational even now, and we are now roughly midway between the pink upper trend line and the pink lower trend line. Near the pink lower trend line, we also have the unreconstructed bright green 2019 to date uptrend, currently at 971. And these supports help explain the hesitation seen over late July and early August before the market turned back up again. Now, there have been other patterns here, such as the mid-July break below the late April to mid-July expanding wedge pattern, as well as an earlier mentioned double top pattern. However, they are no longer valid. The patterns in the recent past that we have seen that still resonate today are, firstly, a quite steep bear channel developing from late June through to mid-August, highlighted in dark blue on my daily chart. The bearish pressure of this pattern was disrupted with prices shooting up and out of the bear channel, initially reaching up as far and seemingly hesitating at a former important level, the broken lower time, currently 1035.25 of the December 24 to April 25 bullish shift pitchfork, along with the mauve medium moving average, currently at 1033.75. However, prices late last week motored above that and also through the November 2020 low at 1045, which capped the market at the start of that week, before seemingly halting and turning back lower at the 61.8% Fibonacci line of the significant May to August 24 move at 1061. We're now resting just around or about on top of the previously mentioned November 2020 low at 1045. There's quite an assortment of supports now below, and they consist of the mauve medium moving average near the broken lower time, then the gold long moving average, currently 1028, and finally the green short medium moving average, currently 1021.5, next to the 50% Fibonacci line of the June to August 2025 move at 1022. These have all been resistances except during the last 2 weeks, when we have seen prices punch up through most of them, leaving a wide support band below between approximately 1016.75 to 1032.75. So outside the big rectangle pattern I've spoken about at the start of this commentary, I have little in the form of major new patterns to discuss right now. Just keep an eye on the moving averages and a wary eye on the broken lower time. One final thing, it hasn't happened yet, and we only have today and tomorrow to do this, but we still might be on the cards for a monthly key reversal. Just keep an eye on this idea, and especially on the July high at 1064.25. Chicago soybean meal. 20 weeks ago I linked some of the early 2025 highs into a bright red, now broken downtrend, and then the lows at the time into another purple broken lower trend line. Together they made a January to August descending wedge pattern. This pattern was broken on the downside in late July, and in the process of breaking lower, the market made what looked like a combined dark blue descending expanding wedge pattern, and at the same time a July to August reverse head and shoulders pattern. 2 weeks ago, prices broke up through the dark blue neckline, currently at 1082.60 of the combined, and that's of this combined neckline and upper trend line for the descending expanding wedge pattern. This was not the only thing the market broke higher through, as it also broke higher over the bright red upper trend line and a purple lower trend line, plus the green short medium moving average, currently at 279.10, and now the overhead medium moving average, mauve medium moving average, currently at 287.90. This week the market tried higher still, up through, but not managing to close over as yet. The combination of the 50% Fibonacci line of the whole of 2025 move at 294.5, plus the flatlining gold long moving average, currently 294.90, as well as the significant congestion at 290.80. However, as I said last week, and I quote, all this now has to be taken with a pinch of salt, as we had back in late June what looked like a decent break lower, only to find it was a false break. We now have to look carefully to see if this will also become a false break, just on the upside. End of quote. Yesterday's pullback below the mauve medium moving average, though so far not making a weekly reversal, is not far from making one. We need to see how prices dip below 283.20 to have that, so watch out for today and tomorrow to see where we get below 283.20 and where we close after that. This all still leaves us potential. Actually, I think we may have done it. Let me see what the low is. Yeah, we are below it, so we're on for a weekly key reversal. This leaves us with potential targets topside for the newly constructed reverse head and shoulders pattern, which I gave 2 weeks ago, of a primary target X up in the 296 area, for secondary harder to reach target X2 up in the 30160 area. We came danger close to fulfilling the primary target X at 296 even, with a high this past Monday at 295.40. I'm now wondering if that strike higher on Monday may have been it, as the overhead resistance from the 50% Fibonacci line and the gold long moving average, plus being within a significant congestion area from 282 to 300, dating from between April and August 2020, and also some of which we have constructed in 2025, probably from the same source, between 294.5 to 302.25. With all that being said, I will for now still keep these further targets topside of a breakout of the descending wedge pattern. That's with a primary target X1 up in the 309.70 area, and a secondary much harder to reach target X3 up in the 326.60 area. Just remember, as I said last week, and I quote, part of me is a little loath to place these targets as the break higher came very late, and the chances of yet another false break, this time higher, are also much higher, but for now these will do. End of quote. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates down to 2025, and that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've highlighted now for 116 weeks, yes, well over 2 years now, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. We've been living in the shadow of this pattern ever since. End of quote. I've also added, ever since, and I quote, if there's only one thing you take away from any of my musings, let it have been those words. End of quote. These last few weeks have shown once again that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean meal. Actually, Chicago soybean oil. The key pattern here has been the dark blue April to date ascending expanding wedge pattern, which is currently 52.28 to up off the top of my daily chart. That is or it could also be the lower bright green uptrend below, currently at 48.61, and the dark blue trend line above, making a similar ascending pattern, currently at 48.61 to off the top of my daily chart. Plus this week, a new variation this week, a bright red uptrend further down. Actually, it's in between, but a bright red uptrend below and closer to the market, currently at 51.13, and the dark blue trend line above, making a similar ascending wedge pattern. That's currently 51.13 to off the top of my daily chart. To explain this strange conundrum, I'll initially refer to my commentary from 11 weeks ago when I said, and I quote, new pattern emerged over the last month or so, and one I was warned about may kick off 2 weeks ago. So that is now 13 weeks ago. And I carried on, and has actually done so since, though the break has not fully stabilized as yet. It is the dark blue start of April to end of May ascending wedge pattern. This pattern has the appropriate number of touches on each side. Now, back late 13 weeks ago, we had a brilliant breach and break lower, but as I said 12 weeks ago, and I quote, clear consecutive closes below this dark blue lower trend line, and I will feel obliged to lay out potentials and even possible targets below for this pattern. Something I am not confident in doing just yet, as I fear a possible false break lower. End of quote. Since then, this pattern has repaired itself and the market went back well within it, climbing higher during most of July and after June's monthly key reversal up, but turning lower once more in late July, with a weekly key reversal down 3 weeks ago when prices tried to enter the overhead congestion, stretching between 56.34 to 59.44, and just found out how this congestion only too easily eroded the bullish incentive. Now, as I've said repeatedly, and I quote, there is one other feature I'd like to draw your attention to, and it is to look at the possibility that the lows of April and June can come together to form a new lower trend line, highlighted in bright green on my daily chart. This would be a new lower trend line to the original ascending expanding wedge pattern. I've still not fully explored this idea as yet, but I do feel obliged to lodge it in both your mind and my mind just in case. End of quote. That was the situation last week, as it had been for quite a few weeks and still continues to be today. However, I especially noted last week's weekly key reversal up that petered out this week. Not because of the rally or the petering up, but because of its base on the rising mauve medium moving average, currently at 51.47. You see, if we disregard the spike low at the start of June, then the lows at that time were also supported by the mauve medium moving average. And it could be that this mauve medium moving average is becoming a proxy for the lower trend line. Thus, for now I've drawn a bright red lower trend line as a straight edge. But I reserve the right to finesse this trend line closer to where the mauve medium moving average resides. Meanwhile, my conundrum still exists. Do I regard the dark blue trend lines as the definitive ascending expanding wedge pattern, broken but repaired? Do I look at the bright green uptrend below as the real and true lower trend line, but the ascending expanding wedge pattern of the ascending expanding wedge pattern? Or do we look at the still possibly to be finessed bright red uptrend as a true trend line, or is that just really a bit out there? Now, do I also look at the mauve medium moving average as a trend line, because it's done pretty good as it so far? I don't have any answers to these as yet, and I'm wondering how I will. In the meantime, the only thing I can add is something said 2 weeks ago, and I quote, something I said then. The singular mauve rising medium moving average, currently 51.47, excuse me, as well as the old March 2013 high at 51.26. And, to be the devil's advocate on this, if these go, then the green uptrend and the potential mentioned earlier of an even larger pattern may be on the cards. End of quote. Thus it seems that if the mauve moving average breaks, not breaches but breaks, then one of the larger patterns may be, as I said, on the cards.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.